All right, what's up, guys? I hope you're doing well. Going back at the Fed's monetary policy report. This one's not just a summary. The previous video was basically just going over the grand scheme of things, and now we're going into actual data and graphs, which is much better. Um, it it pleases the ex-physicist in me, to say the least. Um, love actual graphs, but okay, so basically this one's just the labor market. I'm going to break this up into sections because if you look at the scroll bar, this thing is a beast, can be a beast. I haven't even counted how many graphs are in here. Looks like 45, and this is just part one. So this is fantastic. I've never actually looked at one of these. So we're going to go through it bit by bit and get actual graphs. So, one of the things that we know about the labor market that I've talked about a little bit in the summary video too is how it's been really tight. And they give some speculations, and I don't know if speculation is the right word, but they give some reasons that they think it could happen. Regardless to say, I mean, like we know that not much supply for labor and not much, but a lot of demand. Um, and so that basically just makes it really tight, hard to hire people, hard to keep people, and so on. And they give some stuff later on that we'll go through bit by bit. Okay, so starting with employment, payroll employment increased by 3.5 million jobs. And by the way, for the monetary policy reports, they're kind of they're semi-annual, right? If you didn't watch the previous video, and so this is for the second half of 2021. I believe it's July to now, or whenever it was. In the footnotes, they give a specific end date. I think it was like February 24th, 23rd or 24th, when they stopped collecting data or whatever. And that depends on the exact indicator or the specific piece of data, I guess, because some of them are only collected annually, some are quarterly. It depends on the specific metric. Um, Anyways, so payroll gains over the past year have been widespread across industries with particularly large increase in the leisure and hospitality sector as people continue to return to many activities that have been curtailed by the pandemic, right? So not a big surprise. I think this is something I also brought up in the previous video that you just don't hear people say all the time, whenever they talk about the labor market and everything else, is the fact that we kind of killed these jobs in 2020. So a lot of it's just them coming back, and you can see this. I noticed is non-farm payroll employment. Um, Pretty interesting. It's from the BLS, right? Um, so obviously, I mean, like you see, it's. I wonder when the recession was for 2008, where it crests. Looks like at the end of 2007, and then it goes down, and I can't do that. See if I can zoom in more. Plus, where's the plus button on here? That didn't work as expected. Okay, go back. Okay, never mind. I didn't know it did that. Can I do incremental parts? So that is incremental. All right. So never mind. That's as close as we're getting. Because I don't want to make sure I don't block the video of me. So I think we're good. Okay. But anyways, we can see basically just employment hit right there in 2020 or whereabouts and just literally plummet, right? Um, and then it comes back. I mean, the whole recovery and everything that should be expected. Nothing really surprising in this graph, at least that pops out to me immediately. So the unemployment rate continued to move down rapidly, declining from 6.7% at the end of 2020 to 4% this past January. And this is this figure right here, which is civilian unemployment rate, which is you go up with the GFC recession, basically almost a complete uh, reflection of this one, as you can see, kind of like a little S curve almost, or you could view it as such, I guess. And then it kind of slowly decreases and such, and then we hit this point on which you talk about like maximum employment or whatever, or whatever they deem that to be, because we know it's not a fixed number. Then it spikes immediately, like we know, and it goes back down. And we notice that it's getting around to where it was before, at least relatively. I mean, I don't remember what the exact number was here before this happened. But at least relative to the past 20 years or so, I mean, it's very close, considering everything else. Then we have unemployment rate by race and ethnicity, all relatively the same shape as the original graph, because I guess this one's basically a superposition because it involves all of them. I'm not sure how they divvy up the percentages. I'm assuming it's the same concept of the regular unemployment rate, to where it's basically just your the rate of unemployed people. I mean, and so yeah, basically Asians at the bottom, whites, Hispanic, and blacks, and African Americans as you go up. Same. So demand is very strong for labor, obviously, and then supply remains constricted. So last year's job gains were driven by an appreciable and steady rise in labor demand as the economy reopened and activity bounced back. You know, the whole reopening in the economy, we no longer had only the essential jobs or whatever you had. And so we need more people. But labor supply didn't keep up. I mean, that's kind of what you'd think would happen when you just pay people to stay home. Yeah, I mean, I wouldn't want to go to work if I didn't have to either. And this is pretty much reflected in the labor force participation rate, which is the basically it measures the share of people either working or actively seeking work, right? So people who are actually looking for work. So it doesn't necessarily, so like if you're 30 or whatever and you haven't been looking for a job in, I forget the time, there's a time period for this, like it's like a month or something like that. I don't remember the exact one, but I know, or the exact time, but I know there's a specific like amount of time before you're no longer considered in the labor force participation rate, because you haven't been looking for a job for a specific amount of time, even if you're in like the non-retirement ages and such. So yeah, and then basically just like even though the recovery of employment's been rapid, it's not complete really, because we're nearly 3 million below pre-pandemic levels. Other graphs showing pretty much the same thing, just a different metrics. So you have scalings and stuff as before, same general shape, where you have the inflection down because you're talking about participation rate, and so it's going to reflect this one in a way for actual employment. Okay, so we're going back more into the labor force participation rate. Again, working age adults that are either employed or actively seeking the work itself. I haven't gone through this graph or this chart in, my God, this table in depth. I kind of wanted to do it live just because, why not? Changes since February 2020. I mean, it doesn't seem like that big of a difference, but I'm not sure what the difference is, like how this is relative to other years, since we only have 2 years. So I don't know, like, okay, is 0.3% a massive change for retirement, stuff like that. Not entirely sure. It looks like this is the decrease of the amount from the labor force participation rate, which would make sense, especially for retired people, because we know a lot of people are getting retired. We'll get more into that earlier, and it seems like it gives the reasons for it. Contribution of, yep. So yeah, shows the amount. Okay, here we are. So the retired share of the population is now substantially higher than before the pandemic, accounting for more than 2/3 of the net decline. So the majority of the labor force participation rate decline was from people retiring, about half of which is because they would have retired anyway, because baby boomers are getting old, and so they're retiring and everything else. But another thing that I was going to bring up, and I'm glad they brought it up too, was I mean, people, especially around that age group, are pulling forward as they put their retirements and everything else by a few years. Because I mean, like if you have, it's one of those things. It's a cost benefit analysis, because if I was like 60, and I see everything going on that's been going on since 2020 and everything else, it'd be like, is it really worth my time to deal with all these new things and all the uncertainty and everything else? And why don't I just retire early and not have to deal with it? It seems like that's accounts for the other half of this metric. And then there's the people going in that had to caregive, either for those newly retired grandparents or whatever, or even, I mean, like we did shut schools down, so they bring up parents who like unsure about schooling and stuff like that. So people have to take care of the kids, and that was another major factor in the reduction of this rate. Also, I'm just going to say, finally, reduced immigration likely has held back total labor supply, even though the effect on labor force participation rate is likely to be much smaller. And it's what, 7? So if you want to look more into this, but I'm just not really going to say anything about this one because I don't want to get all too political, and I haven't looked into it too much personally to really have an opinion on it. That's one thing you'll eventually notice about me, and whenever as I do these videos and stuff like that. It's like I'm not a very opinionated person. I don't know if it has to deal with what I used to do with physics and everything else. Well, it was very data driven. Um, but it's one of those things. I have a few things on which I have a very strong opinion, but that's because I've spent a lot of time researching that topic from a variety of angles, looking at different points of view, actively talking to and searching for people who disagreed with me to see and understand their point of view and everything else. And there's not that many things that I'm that opinionated about. Everything else is like, I mean, I don't know. I can kind of argue from both sides, but I don't really have a set opinion on one way or the other. So there were 2 job opening. Oh yeah, this one. Basically showing vacancy to unemployment ratio. I don't see it defined anywhere, and I didn't look it up beforehand. I mean, that's the whole point of these videos, is to kind of not really do it on the fly, or what it is to kind of do it on the fly, but to just kind of, it's an active learning experience and everything else. So I'm assuming it is percent ratio. So this is the blue one. Yeah, this curve, this blue one is for this y-axis, while the farm quits rates are over here. They both end up in the same spot anyway. So it looks like for this blue curve, right, we're showing that 2 job openings per unemployed person, which means every person who was unemployed in the economy, there were 2 jobs they could have possibly gotten to or would have access to on average. Excuse me. So yeah, very well, probably easy to find a job. It was for me at least, but it's also, I don't know how anecdotal that is, since it's one of those. I am a recent graduate of a physics degree, and have the GPA and research experience and everything else to back it up. So I don't know, but from other people I've talked to who either didn't go to college or anything else, which is a completely separate topic, they haven't had trouble finding jobs either. Could be completely different, could be completely anecdotal. I don't know, but it kind of reflects this data point a little bit, I guess. But also quitting. So the share of workers quitting jobs each month, an indicator of the availability of attractive jobs, um, climbed from 2.4 to 2.9%, and this is an all-time high, right? So an all-time high in people quitting their jobs, which kind of makes sense considering all of like the stimmy checks and everything else. And they go on later in here talking about people saving, having excess savings and stuff like that later in the article, which we'll get into. Um, so it's not that surprising. Probably other factors in there as well. I don't know. Just kind of curious too, because I'd like to point this out and kind of talk about the curves itself, because we see it kind of peak here and then sharply declines right around the financial crisis and everything else, which makes a lot of sense. I mean, like if you're going through a massive recession, I mean, people are going to quit their jobs less because the emphasis is more on, and I say that because I mean, there's an obvious decline in the curve, so at least there's a correlation. That you could say. Um, but correlation is not causation. So there's other things. There could be other things involved. But anyways, um, I mean, if you think about it, if you're going through a massive recession, why would you quit your job? Because at that point, it's like any money. I mean, sometimes you just have to eat. You have to have a roof over your head. So you might as well, even if you absolutely hate your job, sometimes you just have to. You got to do what you got to do. Sucks being an adult sometimes. Yeah, employers continue to report widespread hiring difficulties as well. And now we're getting more into wages and everything else. So total hourly compensation as measured by the Employment Cost Index, which includes both wages and benefits. That's another thing involved too, because you get paid, but it's also like your employer has to pay for the benefits of what you get as well. Those just aren't free. They're free to you depending on the benefit package and whatever. There's a bunch of variables there. But yeah. Anyways, rose at an annual rate of 5.2% in that second half of 2021. Yeah, well above pre-pandemic levels. And this is figure 6. Anyways, so measures of change in hourly compensation. You see a general trend up. And this seems to be divided by sector, or at least here's business sector. The Atlanta Fed's wage growth tracker. I haven't gone in depth on what's actually in this, how they actually track this stuff. So I don't know. It could be something like the CPI, and to a certain degree can be completely bogus, but I don't know. Employment cost index, private sector, and then average hourly earnings, private sector, which looks to be, I think it's this one, because we got green, blue, this red. I need to turn up the brightness on my laptop. Maybe I can see shit better. Yeah, it seems to be this thin black curve right in the middle, which I wish I could point and highlight stuff on the graphs themselves, but I can't. It just pulls the graph over. General trend up, but keep in mind this is nominally, just because the actual number of your wage goes up doesn't really say anything about your purchasing power, which we get into here. Wow, what a surprise. Even so, in the aggregate, these wage gains do not keep pace with the rise in prices last year. So the previous CPI print was 7.5 for 2021, which is here. We see our biggest one, it looks like just below 6%. And that is the private sector, with the lowest one being whatever this employment cost index is. I'm assuming this is from the business's point of view. Haven't gone into that index, to be honest. Mine actually are probably, well, actually, since it's in here, I'll look it up and probably do a separate post on it. on the website and everything else, because that's what I do a lot of the posts on, is when I find stuff like this where I'm like, I don't really understand what this index is or whatever this metric is, and then I'll actually like go down and like research everything that I can about it and produce content for it. Because it helps me learn better. It also gets people to engage with it, and so they can learn it if sometimes they catch something that I said was stupid or whatever, and then they can call me stupid, which is perfectly fine. So, differences in wage and employment growth across jobs and workers. Now we're going more into, this is more different sectors and such. So, as an example, the compensation growth for leisure and hospitality jobs, as measured by the Employment Cost Index, was stronger than the goods producing and service producing industries. However, job openings for this industry are very high, which, in combination with strong wage growth, indicates the comparatively weak employment rebound in leisure and hospitality now largely reflects a lack of available workers. Um, makes sense. I mean, I think I talked about one of the previous videos. I was getting ice cream at Sonic last summer, and they had posters everywhere, like 3 or 4 posters all over the stalls in Sonic, and they were starting positions were at $10 an hour. And I worked at Sonic in high school, and I mean, I got tip wage, so um, yeah, it's like 325, I think, or 225. I don't remember. Um, anyways, there you go. And here's an actual graph. So we see leisure and hospitality just skyrocketing, which, I mean, this makes sense, trying not to get away from my previous point. I mean, especially with everything that's been going on, it's like, do you really want, I mean, honestly, this is it's a hard industry. It is, but it isn't. Let's say that it can be emotionally taxing. I mean, one of the things that I really was, I learned a lot about I learned most of my social skills and everything else, and actually dealing with people, because I worked in leisure and hospitality, both at Sonic and at Lowe's. So I worked at Sonic as a car hop, and then I did Lowe's. I was an outside lawn and garden at first, and then I went to appliances. Um, and then helping people, like, design kitchens and stuff like that with all their they can get suites for their appliances, and like cupboards and all that other stuff, cabinets and stuff. But anyone who has worked in retail completely knows why they want to get paid more. And I think a lot of it too has to do with the fact is people know that businesses are having a hard time getting jobs, and so they know they have the leverage. And so, I mean, like, can you really blame them? Because it's relatively low paying work, depending on where you are, um, and you deal with rude people all day. So there's that. Whereas, like, goods and services production, I mean, they're still growing, just not nearly taken off as much. I mean, hell, look, goods production is less than 4, and then we're looking at this one at more than 8, and this is a rate, if I remember correctly. Or is it just a standard index? I think it's a standard index, I guess. Total compensation. So I guess it looks like it's just the index itself. So yeah, either way, it's still double. Shows a lot. So job losses initially aligned closely with workers' level of earnings, with lowest wage jobs, which are normally in the service producing industries, experience the greatest employment declines, which we see here, where it's brought up in your top, bottom, and then dividing the middle class ish. I don't know if it's really classes, it's quartiles and earnings, so kind of. Not really, I guess. I don't think that's a relevant comparison to say like this is lower class, this is lower middle class, this is upper middle class, and this is upper class or whatever. Because especially the upper class and everything else, they're typically not working for wages, um, or they have businesses or whatever. So employment. Let's see. So yeah, as you can see, I mean, they dropped so much significant. I mean, look at they're talking about how much it's gained, right? Um, but I mean, yeah, it's gained so much more, but they started from a much lower base. In terms of after the massive drop off due to the whole pandemic and everything else. So it makes a lot more sense because I mean, this is your job that it's like the restaurants that were shut down. So like the cooks and the waiters and everything else and whatever. Whereas like your typical like your physicist or your lawyer and everything, they were still hella busy this whole time and they were still working. So it makes sense, and then it's distributed accordingly. Um, Median wage growth, and then kind of reflecting this above one again, like it's flipped, where you have their wages are growing the most because they need the most incentive to go back to work. Just because, from multiple reasons, probably. And we've kind of already gone over. But yeah, that's all I really got. I mean, honestly, if I was still in high school and still working at Sonic, I would probably want a lot more. Maybe not a lot more money because I never really agreed with that. Getting a whole bunch of uh, I did a video on this a couple months ago. It was just me sitting in my car getting it off my chest. But the whole like the reason you get paid and everything else, the whole reason you have a job and the whole reason someone creates a job, because ultimately someone had to create that job for you, right? And so they want to hire you so that you can produce value. And they're going to pay you relative to the amount of value you produce. That's what money is. Money is it's considered a store of value depending on your point of view, or it's supposed to be considered a store of value. We'll go with that. It's supposed to be, and so the more productive you are, the more value you produce, the more you should get paid. That's how you get raises. Is you produce more value, and then your employer wants to keep you, so they have to pay you more because then their competitor will come in and their competitor will come in and be like, I'll pay you more, and then you leave. But they want to keep you because you're producing more. That's the whole point. Um, so I mean, like as long as you don't try to squeeze it out, like I don't know how to pronounce or how to really put that. Not at the top of my head, but it seems kind of self-explanatory to me, at least. I might do a little bit more of an in-depth video on that. Um, so we are down to median. No, oh yeah. So median hourly earnings by race and ethnicity, and this is wage and salary. So we have annual median. Where's the difference? Is it the different graphs? So we have the 2 years here, and this is the delta. So I guess it's just all of them. It's not separating wage and salary. Okay. And so you see, like all of them are each respective race is up, um, relatively the same, with Asians the most and whites, and then I can't really tell between these two, between African American or Latino. And then Asians had the biggest delta. It kind of reflected the same, and then whites, and then African Americans and Latinos are kind of pretty close together. And this is one I actually highlighted the footnotes because it says this specific metric is only published annually. And so it's like they say here, it is not possible to infer from these data whether some demographic groups experience faster wage gains more recently. Because again, the whole report itself is only for the latter half of 2021, but this specific metric is only produced annually. So there is a difference, or a little bit of a, I guess, separation, you could say, in the data itself. Okay, so accelerations. So the extent to which sizable wage gains raise firms' costs and act as a source of inflation pressure depends importantly on the pace of productivity growth. This goes back onto what I was saying earlier about it's all about productivity. If you can't produce, you won't have a job because you'll get fired, because that's not a good investment for the business owner or your manager, whatever your structure happens to be. Um, and so, yeah, they actually have a graph for this. And this was showing how much its productivity's changed. And in the paragraph here, they talk about how much it's increased by I think it's a whole percentage point, but 1 percentage point faster than the average pace since the mid 2000s. It's right there. Because they're only talking about this section to this section. So we have completely different things here. They're not even talking about this section. But yeah, and that's the end of the labor market stuff when we get into inflation. And as you can tell, this has been a 30-minute video. I didn't realize I went that long. And this is where the scroll bar is. So we have a lot of reading and talking to do to go over all the stuff. And that's only part one. It's not even like a fifth. It's probably about a fifth, maybe a fourth of part one. But anyways, so that's pretty interesting. It's nice to actually see, graphs and charts and tables and stuff that actually back stuff up. So yeah, I hope you guys have a good night, and I'll see you on the next video, which will probably be about, if I can scroll down to it, the inflation hot topic. This I'm more acquainted with. The metrics with like the labor market and stuff, not so much. That's still relatively new. I haven't done too much of a deep dive into that kind of stuff just yet, but the inflation I'm much more acquainted with. So we'll see how that goes. Anyways, I hope you guys have a good night, and I'll try not to keep these videos so long.